Hello friends. The question I'm going to solve today is one of the amazing question, right? This is question 4. This question will cover all the ratios, profitability ratios, investor ratios, gearing ratios, all kind of ratios, and also dark pool trading. What is dark pool trading? So this question is about that. So don't forget to watch this video till the end because we are going to solve lots of calculations here, lots of ratios, and we are going to analyze the company, whether this company has to be sold off or not. So that's the background about the company, right? Before I start, I can take you to the requirements. Requirement A is for 5 marks. It is asking, explain what a dark pool network is or dark pool trading and why Chawan company may want to dispose of its equity stake in Odin company through one instead of through the stock exchange where Odin company shares are listed. So you have two requirements here. Why? What is dark pool and why they want to use this for disposing the equity stake. Okay. So we are going to read. We don't need all these numbers for that. It's just for 5 marks, right? So you can just read this portion. First paragraph, second paragraph. Okay, so the first paragraph is saying the Treasury Department of Chawan Company, a listed company, aims to maintain a portfolio of around 360 million consisting of equity shares, corporate bonds, and government bonds, which it can turn into cash quickly for investment projects. So how many it is? 360 million. The portfolio. Chawan Company is considering disposing of 27 million shares, valuing at 2.15 each. Disposing 27 million at 2.5 each, which it has invested in Odin Company. So Chawan Company wants to sell off their stake in Odin Company. Out of 360 million, they're disposing $360 million. They want to dispose of 20 million shares, valued at 2.15 each. The head of the Chawan Company's Treasury Department is of the opinion that should the decisions be made to dispose of its equity stake in Odin Company, this should be sold through a dark pool network and not sold on the stock exchange where Odin Company shares are listed. In the last few weeks, there has also been rumors that Odin Company may become subject to takeover bid. So there are rumors that it might become subject to takeover bid. Odin Company operates in a travel and a leisure sector, and the poor weather conditions in recent years, coupled with the continuing recession, have meant that TNL sector is underperforming. Over the past 3 years, sale revenue fell by an average of 8% per year in the TL sector. However, there are signs that the economy is starting to recover, but this is by no means certain. Right? Below you are given the extracts of the financial statements and other financial information. You can see you are given the balance sheet of Odin Company for the 3 years, right? And you are given the income statement too for the 3 years, and also you are given some other financial ratios information such as the company and also the sectors average share price, the earnings per share, the dividend per share. You are given the equity beta and average equity beta, the sectors and the company's equity beta, and also you are given the risk free rate and the risk free rate which is at 4% and the market return which is 10%. That means you are given this information. Why? Because you have to use your CAPM whenever you are given risk-free rate and market return or this market risk premium, and also you are given the beta. Here you're already given the equity beta, so that means you have to use a CAPM. Now what you are required, one is dark pool, the second is discuss whether or not the Chawan company should dispose of its equity stake in Odin company. So now you have to discuss whether this Chawan company they should dispose of their equity stake in Odin company or not. How are you going to discuss this? Not through theory. You need calculations. Provide relevant calculations to support the discussion. Up to 10 marks are available for calculations. This is very important. It's for 20. So that means 10 marks for calculation, 10 marks for discussion. Right? To discuss for this 10 marks. Right? What happens in this question is most of the candidates, they keep on doing calculations. They discuss only 1 or 2 points. Or they do calculations which is very little, 1 or 2 calculations, and they started discussing so much. So it should not be done. This is equally, you have to divide. 10 for calculation, 10 for discussion. And first you have to start with the calculation part. So first we are going to start with dark pool network. We'll see the marking scheme, how it has been given. So here before this, I always follow this. I always go through this box. Very important that you first start with this box. When you start reviewing your answer, right? This should be done after you actually you actually make an attempt to answer that in the strict exam condition, and then check your answer. While checking your answer, go through this box first before checking your answers. This is really helps a lot. So the top tips. This question requires analysis of a company's past performance. So it requires analysis of company's past performance to help decide whether or not to dispose of shares in the company. See, when do you take a decision to sell a company? You decide to sell a company only when that company is not performing well. It's loss making. It's not going to make any profit for you in the future if you hold it. So to know whether the company has been profitable in the past or going to be profitable in the future, you need to do calculations. You need the trend. You need to do calculate ratios, right? This is a tricky question to interpret. See, that's why I always tell you to go through this box. These are the reasons. They will give you some hints. Some keys are always there in this box, which you will not get anywhere, because this directly comes from the examiner itself, right? So this is a tricky question to interpret. Why this is a tricky question? Because if rushed, it can easily be misinterpreted as a valuation question. This is the thing which you should not do. This was a common error in the exam. It's a common error. This was the common error. Misinterpreted as a valuation question. Because you saw that word takeover or selling. So you think that you have to value this company. No, that's not what the question asked. When do you value a company? When you go for a mergers and acquisition. This is not mergers and acquisition. This is you are selling off. You are selling off only when you are not happy with the performance of the company. To interpret the performance of the company, you need the past trend, past record. You need to do ratios calculations. Not just 1 year or 2 year, at least 3 to 5 years you need. Right? Once you have interpreted what is required in this question, it is fairly straightforward in terms of technical skills required. See, this is easy in terms of technical skills because it's just you have to calculate ratios. There are numbers of ratios. We are going to cover one by one here. So if you are weak in ratios, this video is for you. Examiner's team comments. Let's read what is the examiner's team comments. Never underestimate the examiner's team comment. We don't read it because we think it's irrelevant or it's not so much important, it's wasting my time. No, please take some time. It doesn't take so much of time, maybe 1 or 2 minutes. Spend that time reading it. It will help you. Trust me, this will help you a lot, so that you don't make those mistakes which other candidates in the past has already made. You cannot worth losing even 1 mark for this paper. Each mark is valuable. Each mark counts. Even if it's 1 mark, it counts. Candidates fail at 49, and I don't want you to be the one at 49. That's why I always stress on this. These are some valuable source of information which no one will provide you. Okay, so good answers for this part, which provides calculations in a tabular format. This is another word, calculations in a you see, your calculation should not be so messy. One ratio is here, one ratio is there. No, it should be neat, tidy to read, understand, one by one, labeled clearly which ratio are calculated, and then you have to write the formula and then calculate the answer. It has to be in a nice tabular format, and then discuss the results in a holistic manner. When you discuss the results, it has to be in a holistic manner as a whole, not one by one, not single line. You're not discussing line by line. Okay, 2003, this happened, again it decreased, again it increased, this ratio, this increase, this decrease, this increase. You are not going to do that line by line. We are going to show how to answer this in a holistic manner. okay, and gain the majority of the marks. However, some responses tend to be unstructured with few calculations to back up what was being said. Some responses also tend to be largely descriptive and piecemeal, where a ratio or trend was calculated and commented on, but the larger piece was discussion were missed. I have told you before itself. You are either doing too much calculations or you're either doing too little calculations. It should be balanced. Your discussion and your calculation has to be balanced. 10 marks each. A surprising number of responses made errors in calculating ratios. Made errors in calculating ratios. Never take your ratios too lightly. I know most of you are good in ratios because throughout, even in a school level, in a degree level, even in a before papers, right? F level papers, we have been doing ratios that in fact, most of the people they love doing ratios because we have been doing it continuously over and over again. So we know the formula and everything. But still, when you come to this paper, candidates make a lot of errors in ratios, and they are not a big errors. They are very small, tiny errors, right? So don't do that mistakes in ratios. Or only gave ratios for 1 or 2 years. Only gave ratios for 1 or 2 years, not enough. Just by analyzing 1 or 2 years ratios, you cannot say that a company is a profit making or a loss making. At this level, such an approach will not gain many marks. It is also difficult to discuss the key findings in any meaningful manner without examining a trend. When you don't find ratios, when you don't see the trend, you cannot discuss whether you should sell or not. But this cannot be done from examining 1 or 2 years data. It should be for a larger period of years, at least 3 to 5 years. Now let's see the marking scheme. So explanation of dark pool is around 3 to 4 marks. Let's say 3 marks. Explanation why the company want to use one, 2 marks. So you are getting a 5 marks. And for the second one, B part, 10 marks for calculations. How? Profitability ratios, investor ratios, other ratios, trends and other calculations. Trends means the changes. You are seeing the changes, percentage change, right? And other calculations. Now note, maximum 7 marks if only ratio calculations are provided. 7 marks. So to get the other 3 marks, you need to do the trends and other calculations, not just ratios. Don't just memorize some list of ratios and start calculating all the ratios. Use only those ratios which are very relevant for this case study, where you have all the information which you need to calculate that ratios. Right? You don't start calculating all the list of your ratios. Let's say that you have studied some 20-25 ratios and you started using all the ratios here. Please don't do that mistake. Now for discussion part, how the marks are divided, you need to know, because when you don't know this, you don't know where to focus on, which part to discuss about. Okay, so first is 2 to 3 marks for discussion of company performance over time, then company performance against competitors, then the actual returns against expected returns, then you need to the discussion of need to maintain the portfolio and alternative investments. What is the need for that investment in that portfolio, or should you sell it, or are there any alternative ways of handling it? Discussion of future trends and expectations. Whenever we talk about performance, when calculations are there, don't always be backward and always focus about past performance, only past history, only calculate some ratios and give something. You also have to discuss of the future trend. What is the future of this market? What are the expectations that you need to discuss in any question, in AFM, whenever this type of questions appears to you? Discussion of takeover, rumor and action as a result. Always use your case study information to the maximum possible you can, right? There was a discussion about a takeover rumor, right? So you can use that piece of information here for discussing. Don't leave it unattempted, because there was about something about takeover rumor was there, we read it. So use that in your discussion. Whatever you see in a case study, please try to use that piece of information in your case study, in your discussion part. You will get the points for discussion. This is how you get points, more and more points for discussion. Because I know candidate For ratios and all, you will be able to calculate perfectly, all right, that's all right. But when you come to discussion, you run short of points. You don't know what to discuss about. One point you start discussing from different angles over and over again. Don't beat around the bush. So use that case study. Don't just write general discussion. And other relevant discussion or commentary 1 to 2 marks. Now let's go to the answer. The first part where you need to discuss what is a dark pool network and why the company may want to use one. Right? So here, first paragraph they told why, second they told why this company may want to use, and third is like a conclusion. Can you see how the answer is divided into different paragraphs? This is how your answer should be. Let's see what is dark pool network. All these are your theory, but I'm just reading once again for you to refresh your knowledge about dark pool network. A dark pool network allows shares to be traded anonymously away from a public scrutiny. No, okay, so it's away from public. Public doesn't know who is trading. The identity is unknown. No information on the trade order is revealed prior to its taking place. The price and the size of the order are only revealed once the trade has taken place. Two main reasons are given for dark pool networks. First, they prevent the risk of other traders moving the share price up or down. Other traders cannot move the share price up or down now. So it removes that risk. Second is, they often result in reduced cost because trades normally take place at the mid price between the bid and the offer. So cost is reduced because broker dealers try to use their own private pools, thereby saving exchange fees. Now let's see why the company is using. Chawan company is holding in Odin company. Okay, in Odin companies 27 million shares out of total of 600 million shares. That is 4.5% if you calculate as a percentage. Right? How 600 million shares? This you have to calculate. It is not given, right? It's not 27 over 360 million. Just check. This 207 million is number of shares, right? And this 360 million is the price, the total value of the share. You cannot divide 27 by 360. You have to find 27 out of total number of shares. What is the total number of shares? You have to go to your balance sheet to find that, right? So your equity is 300 for all the 3 years, right? And it is at 0.5. So when you have to find the number of shares, it will be 300 divided by 0.5. Therefore, total number of shares is 600. Out of the 600 you are selling 27. This 360 is not the number of shares. This 360 million is like what is the value of that portfolio, right? So if Chawan company sold such a large holding all at once, the price of Odin company shares may fall temporarily and significantly. This you have to know. If something you sell of a large amount all at once sold, price may fall temporarily and significantly. And Chawan may not receive the value based on the current price. By utilizing a dark pool network, they may be able to keep the price of the share largely intact and possibly save transaction costs. So one reason is they want to save transaction cost, and the other one is they can keep the price of the share largely intact. It will not impact on the share price very significantly. That's the reason why they are using dark pool and not through share trading. Make sure that you go through the theory of dark pool trading. It's there in your textbook. Although the criticism against dark pool system is that they prevent market efficiency. So this is one of the criticism of dark pool is that they prevent market efficiency. How? By not revealing bid offer prices before the trade. You are not offer the bid before prices. Proponents argue that in fact market efficiency is maintained. Okay, the one who supports dark pool trading, now they are saying is that market efficiency is maintained. How? Because a large sell of shares will not move the price down artificially and temporarily. So this is all about dark pool trading. Now let's go to our main question, which is for 20 marks. So you have to be good with your ratios. Okay, let's start. Ratio calculations focus on investor and profitability ratios. Yes, you don't have to calculate all type of ratios. Mainly you have to calculate these two ratios. Most of the time, even in your AFM, you have to use your profitability ratios and investor ratios most of the time. Mostly investor ratios you have to use. Your EPS, your price earning ratio, dividend yield, gearing, all these ratios you have to use. As an AFM student, you should know this. And by the way, you should memorize the formula because the formula is not given in the exam sheet. Right? All these ratios, none of them are given in the formula sheet, so you have to memorize the formula. And as you can see, it is in a table form. 2002, 2003, 2004, 2005. Your answer also has to be presented like this in a tabular form. So first they are starting with the profitability ratios. These two are profitability ratios. I'm writing P for it. And the rest all. Right? From here to here, all these are investor. Let me write I. These are the I ratios. Right? So first let's start with the profitability ratios. The first one is operating profit margin. That is operating profit divided by sales revenue. They have already given you the formula. So we'll just do for 1 year and the rest all you know how to calculate, right? For 2002, you are not calculating because you have been given this balance sheet or income statement from 2003 onwards, 2003 to 2005, right? So you're not given 2002, you cannot calculate, right? So operating profit 218. Okay, let me write here. 218 divided by sales. Sales here is 1342. Likewise, you have to do for the other 2 years also. And you will get how much we got? 16.2% for 2003. Now let's go to the second ratio. Operating profit divided by capital employed. Operating profit will be same only. Your capital employed. What is your capital employed? You have to go to the balance sheet to take your capital employed. Right? Your capital employed is this plus this. Let me write here. Capital employed is your equity, right? Total equity plus your total non-current liabilities. So it is in this case 605. That is your total equity plus your non-current liabilities. Don't add your current liabilities. Most of you might think this is your capital employed. It's wrong. This is not your capital employed. Your capital employed is total equity. Only you have to add your non-current liabilities, not your current liabilities. So you are adding 365. This will be your capital employed for 2003. And likewise for 2004 and 5 also you can calculate. And for the 2003 you are getting 22.5%. Now earnings per share, right? Your earnings per share you have to calculate. When you see in your other information, this average earnings per share is for TL. So don't get confused. You are finding for Odin, right? So first you have to go to your earnings to get your earnings per share. Right? So your earnings you will get from here. What will be your earnings? It will be What will be earnings? Come on, tell me. I'm giving some time to you to think. What was the earnings per share they got? 0.27. Okay, so earnings per share, here they didn't give the formula. That is earnings divided by share. Your earnings will be this. Profit for the year. Profit for the year. This is your earnings. And your share is 600. From the balance sheet, you have to take 300 divided by 0.5. We already got the 600 will be your number of shares. So it will be EPS is 160 divided by 600. You will get 0.27. And likewise for the other 2 years. Let's go to price earnings ratio. What is price earnings ratio? How to get price earnings ratio? This earnings ratio is this only. This are your earnings ratio. Your EPS is your earning ratio. You can call it, there are two names. One is earnings per ratio, one is earnings ratio. Both are same. Let me write here. So that later you can refer to this and you don't get confused. They are same only. But two different names can be used. Either they are known as earning ratio or either the examiner can say earnings per share. So price divided by earnings per share only basically. That is your PE ratio. Price to earning ratio means your PE ratio. Right? So earning ratio is 0.27. Price you have to use from here. Your price, all your prices is given here. Which price you will use? This price. Ordinary company's average share price from here, starting from here. From 2003, don't go and start 2002. This is 2002, please. Let me put an underline so that you can see the difference. You're not using this here, right? Always check the year, which year's figure you're taking. Don't get confused there. Don't go and take 2.1 as the price. So 2.5, right? Let me write here PE ratio. PE ratio is price. This is 2.5. Divide by what was the EPS, earnings per share for 2003 was 0.27. So you will get 9.27 something, but it is rounded up to 9.3. Always round up to one decimal place. The PE ratio. Right? Now let's go to the gearing ratio. Gearing ratio formula is debt divided by equity, right? So when we go to, and 2003 is 37.6%. Okay. Let's go to gearing. For gearing, you have to go to the balance sheet. Now you always have to know where you can get the ratios figure. If I'm finding profitability ratios, I have to go to my income statement. If I'm looking for gearing ratios and all those things, I have to go to my balance sheet. Even gearing ratio, acid test ratio, all these ratios are from my balance sheet. So gearing ratio, debt plus debt over equity, right? Now your debt, if you are taking your debt, please make sure that you don't take your current liabilities. You are only taking your non-current liabilities. This one 365 and your equity is 605. Only this two you are taking. So for the first year, gearing ratio, I'm writing here 2003 gearing ratio. It is, what is the debt? Long-term debt is 365 over 365 plus equity 605. Likewise, others also you can calculate. You are getting 37 point something, 37.6. Round it up. Interest cover. Interest cover, they have given the formula operating profit divided by finance cost. Right? So I'm not calculating it, it's easy. Let's go to the income statement. Right? Operating profit is 218, finance cost is 23. So 218 divided by 23. That will be your interest cover. right? And also whenever you write ratio, please make sure that if it's as a percentage, write it as a percentage. If it is not, if it is without percentage like PE ratio and interest cover, write it without percentage. Don't go and put percentage in interest cover. It is 9.5 times, right? Or 9.5, but it's not 9.5%, right? Don't go and put percentage under all the ratios. Please don't do that. Like your EPS, earnings per share, this is in percentage, this is in dollar, this is in times, like, or 9.3, just keep it as a number, but don't use percentage in all the ratios. That is another mistake, common mistake. Okay, now let's go to the dividend yield. What is dividend yield? What is the formula for dividend yield? This you have to know, it's not given anywhere. Dividend yield is dividend per share divided by the share, right? The share price. Dividend per share divided by share price is dividend yield. Here they have calculated for 2002 also, one also, if you see, because this is taken from this information, and in this information we have 2002, right? So let me go and check this. Okay, dividend yield is as percentage, so it's very easy. It is just dividend per share divided by average share price. So dividend yield in this case, I will write it here, dividend yield or dy, it is dividend per share. In 2002 it is 0.15. I'm writing 2002, 0.15 divided by 2.1. Dividend per share divided by average share price. That is your dividend yield, which will come as 7.1%. And likewise for all the other years. Now let's go to, this is only for ordinary company. Please make sure that you underline like this, because you also have to find for the sector. Remember, you have to compare, in the marking scheme it was given, you have to compare with the sector, you have to compare it with itself over the years, you have to compare this with the competitor and all. Here no competitors here, so no issues, right? So for leisure sector, we can find these two ratios, price to earnings ratio and dividend yield, by using the same table only, this table only. That's why it's for all the 4 years, right? PE ratio, what is price earnings ratio again? Price earnings ratio is your average, your share price divided by your EPS, right? So this means for 2002, if you are calculating PE ratio, it's very easy. Share price is given, also the EPS is given. So 3.8 divided by 0.32. You will get your PE ratio, which is 11 point something, 11.9. Yes. So likewise, all the other years. Dividend yield. Again, dividend yield will be the same only. Dividend per share, but this time of the TL, not OD. Dividend per share 0.25 and their share price is 3.8. So 0.25 divided by 3.8, you will get the dividend yield, and it is 6.6, 6.6, 6.7, 6.4. Okay, so this was for the sector, because we need to compare with the sector. Whenever sector and the company is given, first, okay, find for the company. You have to find for the company also separately, you have to find for the sector also. And by the way, if you see all these ratios, they are different ratios, new ratios, they are not given here. Don't, just because numbers are given here, right, don't use ratios from here. I mean, don't just use these numbers only in your discussion and say that, let's say for example, I am seeing let's say I'm taking this income statement and saying sales revenue is declining from 2003 to 2005, 1342, 1355, 1185, right? Then what's the use of all these ratios? If I wanted, I would have compared from here also without calculating all the ratios. No, just because all these tables are given, don't think that you can bypass and you can use a shortcut and you don't have to calculate any ratios, and this numbers only you can compare and use. If you're thinking like that, then you are doing a big mistake. With this numbers you are given, you have to calculate ratios. Some information which is not there, you have to bring out those through your ratios. Then you have to compare using those ratios. That's what is the main aim of the paper. You have to bring value. You have to bring value to that case study. You have to bring something new which is not there. That's why we are calculating all these ratios. Now, other calculations. Just by calculating the ratios is not enough. You need to calculate some additional information. Then only you're going to bring more value to your discussion. Always be prepared to do these other calculations. What are those calculations? How to know which calculations to do? It's up to you. You have to use your head. You have to use a common sense that from these numbers, what all ratios I can find in that condition, whatever the numbers are given. Because you might be knowing some ratios, but you don't have enough information to write that to do the calculation or find that ratio. Then don't do that. You need all the numbers to do a ratio. If let's say I want to do some ratio, let's say I want to do asset test ratio, but I don't have the value of the current assets or current liabilities, the balance sheet information is not given to me, then in that case I cannot do my asset test ratio. So it's like that. Ordinary companies sales revenue and annual growth rate average. Growth rate is one thing, this you can use. Always use this growth rate. Whenever you're given from 3 to 5 years, you can find the growth rate, whether it's declining or whether it's growing. So sales revenue annual growth rate average between 2003 and 2005. This is the formula for growth, by the way. I have explained this in my videos. Right? How to find? Go to the sales income statement and see the sales revenue. It is for 3 years. But when you take this, the change is for 2 years only. 2003 to 4 1, 2004 to 5 another year. Right? And when you have to find the change, always take the newest divided by oldest. So the newest here in this case is the latest 1185. The oldest is not 1335, 1342. This to the power of 1 over number of years, 2 years, not 3. Don't take 3. Right? Minus 1. This will be your growth rate. This is the same formula they have used here. Just check. This 1 over 2. This 1 is fixed. It will always be 1 over the number of years. But don't take 3 over there just because it's 2003 to 5. See the change from 2003 to 2004, 1 year, from 2004 to 2005, another year, so 2. Don't calculate 2003, 4, 5, 3 years, no. Right? Minus 1, so it is minus. Just because they told us an annual growth rate does not mean it always has to be positive. If your sale is declining, you will always get a negative answer here only. In this case, if it's negative, please put negative. Don't try to show it as a positive, because it is possible that you can get a negative growth. Because the sales are declining from 1342 to 1185. That's why you will face this negative. And this is over the 3 years. What about between 2004 and 2005? Simply, you just take the difference between these two. Just take the difference between 1185 and 1335, divide by 1335. You will get this is the formula when it's just between 1 year. But this formula comes when it's more than 1 year. When it's over a larger number of years, let's say for 5 years, for 10 years, for 9 years, then you can use this formula. And this this one is also a negative, a bigger negative. Now, these are some other ratios. Average financing cost. We are not so comfortable with this because we don't calculate this ratio this one most of the time. But let's see how this is calculated. Right? Average finance cost. All this 23, 27, 35, they are your interest costs, finance cost you can take from your income statement. And this are your debt plus your bank overdraft. Let's see for the 2003. Go to balance sheet. What is your long-term liability? 365 plus 88. This is this 88. you are adding a bank overdraft always with your long-term liabilities when you have to find the financing, the what is that ratio? I forgot also. Average financing cost. Yes, you're not taking your trade and other payables, only your bank overdraft, because there's a finance cost to this. Bank overdraft and long-term loans, you need to pay interest, but nothing with trade and other payables. Therefore, you're not adding your trade and other payables. This finance cost is 23. So 23 divided by 365 plus 88. For other 2 years also you can do it. And is as a percentage. Share price changes. Ordinary company and TL sector. Right? For this, we can go to this table. Share price change. Here, this one and this one. Just you have to take the change. Let's say for 2003, I want to see the change. So it will be for 2003. 2.5 minus 2.1 divided by 2.1. I will get the change. What will be the change? It will be 19 point something, 19%. That means you can see from 2.1 it has increased to 2.5. By how many percentage? 19%. Same way you have to do for the TL sector also. 3.8 to 4.4. 4.4. So likewise you can calculate the percentage changes. You can see in some it's negative also. Now let's go to this. Ordinary company, return to shareholder, TL sector, RTS. RTS means return to shareholders. This is the formula for return to shareholder. You take your dividend yield plus your share price gain, the total. That total is known as return to shareholders. Your dividend yield you don't have to calculate. Your share price gain also you don't have to calculate. Already these two are calculated before. You just have to copy paste it here. Dividend yield of ordinary company. Go to dividend yield of ordinary company. Just see this one. Not 7.1, you have to take from 7.2 from 2003 onwards. 7.2, 8.3, 6.8. And share price gain also, you have just calculated it. 19 minus 4 minus 8.3. Just check here and here. 19 and 19. Just copy paste. And then add both, that will be your total. You have to find the total and average. Average is 9.7. Add all these three. 26.2 plus 4.3 minus 1.5 divided by 3 because 3 years, and you will get this average 9.7. Keep it ready because we need to compare later. And these figures, they are calculated by using a CAPM model. Whenever you calculate something which is based on your CAPM model, that is known as required return. These are your actual return. This 26.2, 4.3 minus 1 actual return, and this is a required return. You compare your actual with required. That's why we are using CAPM model. Okay, so let's see how we are going to use that. It's very simple. No hard work here. Just check equity beta is 1.5 for 2003. So 1.5 multiplied by 6% because 10 minus 4 and plus 4% because risk-free rate is 4%. And you will get it as 13%. And likewise, you can do for TL sector also. For TL sector, equity beta is different. Rest all remains same. Risk-free rate and market risk premium. So you can find the required return, which is based on CAPM. Here also dividend yield, you are copy pasting. Share price gain, you are just copy pasting. You have done all this too. Add both, you will get total shareholder, find the average. Even for CAPM, the required return, you have to add all this 3 and divide by 3, you will get the average 13%. Here also you have to find the average because later you will need it to compare. Now let's go to the tutorial note. Dividend yield, when calculated as a part of total shareholder return, is normally calculated as current dividend divided. See, this is only when it is calculated as a part of total shareholder return, not when you're calculating your normal dividend yield. Okay, is normally calculated as current dividend divided by closing share price of the previous year. It is highlighted bold. This is not the case in the calculations shown here. Why? Because the closing share price is not given. right? Always exceptions are there. When something is not given, don't break your head to find the closing share price. It is not given. So here it has been assumed that the share price given is the average share price for the year. But a calculation based on the previous year share price would be acceptable in the exam. Even if let's say you are given the previous year share price, right? The closing share price of the previous year, if you are given in the exam, then then if you use that share price, it would be acceptable in the exam. You will not be wrong. You will not be penalized for using that. That's what they're saying. But here since they are not given, so we are just going with the share price for the year, for that current year, which we are using the dividend. So dividend of the current year divided by share price of the current year. That's how we are getting the dividend yield. Now let's go to the discussion part. Calculation part is over, right? And when you see the discussion, just see how lengthy it is, right? So much of things, right? And one thing, when you go with the discussion, this is one tip for you who wants to know how to start with discussion, where to start, because so many calculations. Follow this order, follow your calculation order. How you started your calculation? You started with profitability ratios, then you talked about, then you spoke about EPS, PES, gearing, interest cover, dividend yield. Then we went to this percentage change, return to shareholders, CAPM, all the, so go in that order. The way you have done your calculation, when you discuss also, follow that order. Be consistent with that. Then it will be easy for you to write because you know what you have covered. You know the calculation order, right? You can see. First, you have talked about profitability ratios you calculated. So when you discuss also, you start with your profitability ratios. Then you can talk about your investor ratios. Then you can talk about your other calculation. Then you can talk about the other factors, about the future expectations and about the rumors of the takeover and all those blah blah. So that's an easy way for you to start the discussion. Here also they have followed that same way of discussion. I will show you, right? Let's read paragraph by paragraph. The following discussion compares the performance of Hodden over time to TL sector and against expectations. In terms of it being a sound investment, it also considers the wider aspects which the company should take account of and the further information which the company should consider before coming to final decision. So basically they are giving a short introduction of what they are aiming to do through this discussion. It's always better to give this little introduction to your discussion of what you are aiming to do. What is the aim? The main thing is you are comparing the performance. Why? So that it gives a better information or wider information for the company to take into account before taking a final decision. This type of things you can write. Always write. It's better to write in the 1 or 2 lines and then start with the discussion. So the second paragraph, if you see, and you have to use some of your numbers here to compare, to discuss. Not all the numbers, not all the ratios, but some you have to use. Now, how much to use, how to use is up to you. So in terms of Ford & Company's performance between 2003 and 2005, it is clear from the calculations above that the company is experiencing, see, whenever you state like this, the company's performance is declining from 2003 to 5. Always say this thing. State this. From where you are saying, what is your source that you are saying that performance is declining? From the calculations calculated above. That's it. That will be enough. So it is clear from the calculations above that the company is experiencing considerable financial difficulties. How? Profit margins have, so they first started with number one, they have started with profit margins, because when you calculated also, you calculated profitability ratios first. Keep your calculation and discussion consistent in the same order. Profit margins have fallen. We'll see. Go to profit margin. Here. 16.2, 15.2, 10.4 declined. And so has the EPS fallen, and so has the EPS. Go to EPS. So the second line they are talking about EPS. If you want, you can include the operating profit divided by capital employed, but they felt it's not so important, so they didn't include this in your discussion. See, in your discussion you don't have to include all the ratios, you can exclude some ratios. Only some ratios you need to talk about which you think is very important. EPS is one of the very important ratios. Operating profit margin, EPS, these are very important ratios. So you can see EPS from 0.27, 0.24, 0.12, very badly reduced. Next, while the amount of the gearing appears fairly stable, so they are saying that gearing fairly stable, interest cover has deteriorated. Interest cover has deteriorated. We'll see the interest cover and gearing. We'll see. Just see the gearing ratio, 37.6, 36.9 and 37.1. Almost is stable. It didn't increase or decrease very highly. But interest cover, you see, 9.5 to 3.5. Such a huge deterioration. They didn't include PE ratio, right? Because they have talked about EPS, so it's fine. You don't have to include line by line, I told you before. So they included gearing ratio and interest cover, right? They're following that order. Now, this is the key here. Let's see, let me see. Okay. The reason, this is the main thing that you need to write in your answer. Why has this deteriorated? I always tell you why something happens, why this problem has happened, why there is a rise in this ratio, why there's a fall in this ratio. That why you need to answer. Just don't say interest cover has deteriorated, full stop, and go to the next point. Explain why that interest cover has deteriorated. The reason for this is that the borrowing costs have increased from an average of 5.1% to an average of 7.6% over the 3 years. Borrowing cost increased 5.1 to 7.6 over the 3 years. How are they saying this? They have calculated the ratios. This is why you have to calculate all the ratios. See, this is the advantage of calculating all kind of ratios. Later you can use it to discuss. You can see, you have to link each ratio, by the way. When you see that there's always a connection between the ratio, like interest cover and average finance cost, there's a connection. When an average financing cost increases, your interest cover will fall down. That means interest cover falls down means with your profit. Now you're not able to cover interest. It's falling. The higher the interest cover, the better it is. Remember that. So if the borrowing cost increases, your interest cover will fall. That's how the relationship is. That's why you always never deal with an ratio in isolation. All the ratios are connected to each other. The way one ratio will perform, the other ratio also will perform in that way only. Right? Borrowing cost has increased. That's why there's an interest cover has deteriorated. They are giving the percentage also. They are not saying borrowing cost has increased in 1 year, second year it again increased, third year again they are not saying like this. So you don't have to describe line by line. This is how you have to explain. In a holistic manner. Just one sentence for each ratio you are explaining. This should be your approach. This is the correct approach to gain the maximum marks in the limited time possible. You don't have plenty of time, remember, at the exam hall. You might not be able to cover all the ratios which is there also. All the possible ratios, right? You might not be able to cover. It's okay. But whatever the ratios you have covered, with that ratio itself, start discussing or explaining if you are running short of time. Time is also very important. Please check your time also. Calculating ratios takes time. Don't spend all your time calculating ratios only and just writing one or two, discussing. Now they're moving with the share price. The share price has decreased over the 3 years as well, and in the last year, so has the dividend yield. Just check share price declined or not. Just check the share price changes. 19 to minus 8.3. Even the dividend yield, if you see, From here itself you can see return to shareholders table 7.2 to 6.8. So dividend yield and share price will get reduced because the share price is reducing, right? By the change itself, you can see that the share price is declining. It's going into negative, right? You can even go to the share price table also, which is given in the question, and see that the share price is actually reducing, right? What would this indicate? Always please mention what would a fall or a rise in something will indicate. This would indicate that the company is unable to maintain adequate returns for its investors. Please also see below, right? So the down part is also important. You cannot leave it. What would this fall in dividend yield means? Unable to maintain adequate returns for investors. That's what it means. Although Auden company has tried to maintain a dividend yield which is higher than the sector average, its price earnings ratio has been lower than the sector average between 2003 and 2004. Hold on. How are they saying this dividend yield is higher than the sector average and PE ratio has been lower than the sector average between 2003 and 2004? You have to go up and just check the dividend yield. Just check the dividend yield percentage of the sector and Auden company. If you see in 2003, it's 7.2, while here it was 6.6. Here it is 8.3, here it is 6.7, which is good. That's why they are saying it is having higher dividend return. But yeah, compared to the sector, their dividend yield is good. But PE ratio is lower in 2003 and 4. We'll go and check the PE ratio. Just check the PE ratio of the company and this. Here it is 9.3. Here it is 12.2 in that sector. Here it is 10, here it is 13. But here, just see here, the change comes here. It is 18.3 compared to 13. Suddenly it jumped. It increased so much, even higher than the industry sector. So that's what they are saying here. You need to see this change always. Whenever you see numbers, you need to see where suddenly it's increasing, where suddenly it is falling. These are the areas of concern which you need to bring out in your discussion. When the change is very huge, when the change is very minute, very small, you don't have, even if you don't mention about it, it's still okay. But when there's a very high change, you cannot leave it. You need to mention about it. That's an area of concern. Why suddenly it increased or reduced? So here they're saying, even though dividend yield is higher than the sector average, price earning has been lower than the sector average between 2003 and 2004. It does increase significantly in 2005. We saw that. But this is because of the, now they also they say with something, with a fall and increase, they are saying, they are giving reasons. When you apply this approach, when you have this technique of giving a reason, giving a issue or a change, and then saying why, you will score the maximum marks you can. In any question, not just this type of question, in any question in AFM, this is the way. So, but this is because of the large fall in EPS, rather than an increase in share price. See, there could be two ways where PE ratio can increase very high. One is there is a fall in EPS, or there could be an increase in share price. Why they are talking about this too? But they are saying more than that increase in share price, fall in EPS is greater. That's why that PE ratio jumped from 2004 to 2005. Why share price and EPS they're talking? Just look at the ratio. Just look at this PE ratio. Price divided by EPS. That is known as PE ratio. So when something in your denominator reduces very significantly, when your denominator becomes smaller and smaller, your number becomes higher and higher. Apply, just try and see. And when your price, when something in your top numerator increases and increases, your PE ratio, that answer will become bigger and bigger. Okay, let me prove this now itself. Let's take some imaginary numbers. Okay, let's keep price at 10, but we'll just change the EPS. Always when you do this type of test with yourself, when you're learning, keep one constant, okay, one number same and change the other number. Don't try to change both the numbers. So I'm keeping price at 10, only EPS I will change. EPS before it is 2. EPS after I will change it to 5. Now the PE ratio here it will be 5, here it will be 2. Just see what's happening to the PE ratio. PE ratio is reducing, right? Why? Because this number is increasing. So in short, higher the denominator, lower will be the number. They work in opposite relationship. It's an inverse relationship. Now I'm going to show you, I'm going to change the up part, the numerator, the price. EPS will be same. Let's say price, I'm taking 10, right? And this one, I'm taking 2. It will be 5, right? PE ratio. Now I'm going to change this to, let's say 12. EPS will still be same. It will be 6. I increased this number, this also will increase. Now it works in the same direction. So that's what they are saying here. Where is it? That yeah, there was a significant increase in 2005. This is because of the large fall in the EPS rather than an increase in the share price. So that increase in the numerator was small compared to that fall in EPS. That's why there was a significant fall. Now we'll see EPS. We go to EPS and see. Just see the EPS per share. 0.27 to 0.12. It fell down. So that change was big. Right? But when you see the share price, just check the share price increased from 2. The share price change was not very big. It didn't even increase also that much. The change was slide from 2.5 to 2.4 and then 2.2. Therefore, there is a fall in EPS. Because of that fall in EPS, PE ratio reduced because denominator is reduced. This could be an indication, right? This could be an indication that there is less confidence in the future prospects of Ford and Company, right? Compared to the rest of the TL sector. This further corroborated by the higher dividend yield, which may indicate that the company has fewer. See, because of this higher dividend yield, they are saying, which may indicate that the company has fewer value creating projects planned in the future. Finally, whereas the TL sector average share price seems to have recovered strongly in 2005, following a small fall in 2004. Ordinary company share price has not followed suit. It has not followed the suit. Odin, and the decline has gathered pace in 2005. It would seem that Odin company is a poor performer within its sector. Now they are comparing with the sector. We'll see the share price change. Just check the share price change of the dividend of the Odin company in the TL sector. It has declined to from -4 to -8.3. Whereas the share price gained 15.82, slightly it fell down to -2.3, but again it recovered to 12.1. But here it suffered a fall to -8.3. They're talking about that change, right? That the Odin company were not able to increase its share price, the share price gain, but in the sector they have recovered in 2005. This view is further strengthened. That means they are supporting this view by comparing the actual returns to the required returns based on the capital asset pricing model. Both the company and the TL sector produced returns exceeding their required return in 2003. We'll see. 2003, let's see, it is 13%, here is 12.4%. That means compared to return, your actual return is greater. Right? Just check So that means it's good. When you see the average, it's good, right? And Ordnance Company experienced a similar decline to the sector in 2004. Ordnance Company experienced a similar decline to the sector in 2004. So in 2004, they have in a decline. Just check this. Here the total. I'm sorry, first I compare. Yeah, this was 26.2, whereas this was 13. And here it is 22.4 compared to 12.4. So in 2003 it is better compared to the required return. When you come to 2004, their actual return is 4.3, but required was 13.6. So that means they haven't done well. But when you come to the sector also has seen a fall, 4.4 compared to 13. But when you come to 2005, just see that there has been a minus 1.5 compared to required. So actual return was very poor of the company. And in the industry, the actual return was 18.5 compared to the required return, which was 13.6. That means they have performed well. The sector has performed well, but not Odin Company in 2005. So, however, in 2005, the TL sector appears to have recovered, but Odin Company's performance has worsened. The same thing we just now saw. This has resulted in Odin Company's actual average returns being significantly below the required returns between 2002 and 2005. Right? So just check the actual returns. It is significantly below. Right? Now, taking the above into account, the initial recommendation is for the company to see by taking into the account the above this thing. The initial recommendation is for the company to dispose of its investment in Orient Company. However, there are three important caveats which should be considered before the final decision is made. First, second, and third. It is divided into different paragraphs. So first, we'll go through the first one. The first one is that Chawan company should look at the balance of its portfolio of investment. A sale of 58 million worth of equity shares out of the total of 360 million may cause the portfolio to become unbalanced and for unsystematic risk to be introduced into the portfolio. Presumably, the purpose of maintaining a balanced portfolio is to virtually eliminate the unsystematic risk by ensuring that it is well diversified. The company may want to reinvest the proceeds from the sale of the Odin company if it decides to proceed with the disposal in other equity shares within the same sector to ensure that the portfolio remains balanced and diversified. How 58 million? 360 was the total of the portfolio. Out of that, because here in the beginning it was 27 million valued at 2.5, so 27 into 2.15, 58 out of the 360, right? Yes. And the second one, so it's just not a matter of that it's a loss making or it's not enough that you have to sell. You have to look into this other perspectives also. First, you have to see what if I sell, what impact it will have on the balance portfolio, right? My portfolio will change. That unsystematic risk will come into the account. It will become unbalanced. Second is that the company may want to look into the rumors of a takeover bid. In the market scheme, they have told that 1 to 2 marks is given for discussing rumors of takeover bid of the Odin company and assess how realistic. You have to assess how realistic this will be because they are just rumors. It is that this will happen. If there's a realistic chance that such a bid may happen soon, the company may want to hold on to its investment in Auden company, right? So they are saying that if there's a realistic chance that this takeover bid will happen, it's not advisable to sell now. Hold on the investment for the present time. This is because takeover bids are made at a premium, and the return to the company may increase if Auden company is sold during the takeover. So they're saying keep it for the present, sell it during the takeover, because that time takeover bids are made at a premium, so they will get a higher return by selling at that time. The third is the company may want to consider Auden company's future prospect, right? You have to talk about future prospect. The calculations above are based on the past performance between 2002 and 2005 and indicate an increasingly poor performance. Overall, they are saying what is the past performance. This is an overall conclusion. However, the company is beginning to recover, and even though it is slow, right? The company may want to consider how well Auden companies to take advantage of improving conditions compared to other companies in the same industrial sector. Now, this is your conclusion. This you need to give. If the company decides that none of the caveats materially affect the Auden company's poor performance, that means out of these three, if none of them materially affects the Auden company's poor performance and position, right? Then that means if out of this future prospect is not good, the rumor is not true, or out of this three, right? If they don't improve that poor performance, Auden companies currently is facing a poor performance. If they don't materially improve that position, then there's no use of holding that investment. You have to sell it on. So then it should dispose of its investment in Auden company. This is the final conclusion you are giving. Recommendation based on all your evaluation and analysis. So this is what. With this, we finish our question 4. This is how you have to analyze a situation like this from all the sides, from all the angles. Future prospect, past performance, how it will have an impact on the balance of the portfolio, and all those things. So by now, after seeing this video, you should be an expert in ratio calculations. So that's it for today. Thank you. And don't forget to subscribe to my channel to get updates to my latest video. Thank you.